Welcome back to the channel. We got a lot to talk about. I'm hoping to make this video not super long. We're going to start off here giving an update on the Fed and what happened this week. We are in today's June 14th, and the Fed had their FOMC meeting today, and they decided to not raise rates. The previous meeting, they raised rates, but they were very dovish, meaning they were soothing the markets. So that they came out, they raised rates, but they made the point like, hey, we're almost done. We're getting close, guys. Hang in there. Today, they did not raise rates, but they were hawkish. So last meeting was called a dovish hike because they hiked rates, but they were dovish. And today is what's called a hawkish pause, where they paused on the rate hikes, but they said, hey, we're stopping raising rates today, but we're still going to get you. We're coming for you. So it's all kind of funny to me, the dovish hike and hawkish pause. It just sounds so goofy. But anyways, they did mention that inflation is sticky. It's higher than where they want it to be. The economy's looking good. And when they say that, they mean it could handle more rate hikes. They're still going to be selling securities off their balance sheet because during the pandemic they bought a bunch of securities and put it on the Fed's balance sheet to help stimulate the economy because no one else was buying them. They're starting to liquidate those, so the market will have to absorb that. That is taking liquidity out of the market. They'll continue to do that. But other than that, they continue to be data dependent. And to be honest, the Fed, they don't even know what they're going to do next meeting. They never really do, just because they have to see how things progress in between meeting to meeting. So, they put out these projections, and the projections today came in and they showed more rate hikes to come. But who knows if those will actually happen? For all we know, another bank blows up and the economy takes a turn for the worse. We have no clue. Or the economy takes off and inflation reignites, gets super hot, and then they got to raise rates 10 more times. Nobody knows. They don't even know. So that was the Fed meeting today. We also had inflation numbers come out this week, and you can see here, if you're looking at the bear case, it's green. Inflation's looking good. And we just have to remember that if you were to ask a normal person how they feel about inflation and the cost of living for them, they're going to tell you a different story of what these numbers tell you. And the big key to remember here is that inflation numbers are going down, but we're never going to see prices like we've seen in the past. So things are always going to be more expensive than they were in the past. It's just the rate at which they're increasing is not as fast as it was. So just keep that in mind. I don't know if you remember the last couple. I'm sure everyone remembers it because to me it's seared in my brain when you go to the grocery store and the things that you buy were 5% higher than last week or last month, and it seemed like things just kept going up and up and up, and they're not going down. I mean, the cost of creamer, that's one thing that I always and almond milk, it's not going down. The cost of beef has somewhat normalized a little bit, but it's still a lot higher than it was a handful of years ago. So inflation is green. Prices are still high, but they're not increasing at the same rate they were. So that's good. Interest rates, we just talked about that. They paused, but they may raise again. In Europe and in Canada, they paused for a couple months on their interest rates, but inflation came back and started heating up again. So they actually just raised rates last week. The European Central Bank and then also the Bank of Canada raised rates last week because they saw inflation ticking back up after their pause. So that'll be interesting here to see what happens in the U.S. But also the Fed, they raised rates so fast, and it takes time for those rate hikes to make their way through the system and for the full effects to be felt. So I understand why they're pausing. but I do think there's a chance that they're still going to have to raise more. Um, but who knows? Again, I don't know. They don't know. Nobody knows. When it comes to the banks and the credit crunch, that's still going to be an issue. Um, we still have to work our way through that. That's not going anywhere. Same thing with commercial real estate. I know here in California, San Francisco, one of the largest malls, or the largest mall in downtown San Francisco, just closed their doors. And I think they gave up the property. It was almost, I thought it was like 500 million bucks or something. Something crazy where it's like, whoa, that's a big deal. And so that's still going to be something we got to look at and be aware of. As commercial real estate still going to be, there's going to be losses all over the place, and how are the banks going to handle that? How is that going to affect businesses that are around those companies, around those, think of all the restaurants that are around that mall that are going to get a lot less foot traffic. 6 months from now, how are they going to be doing? So, anyways, these things are going to take more time to work its way through the system. So we still need to get through those. Um, Narrow breadth and rich valuations. Um, it's getting a little bit better. There is still, in my opinion, rich valuations in some stocks, but the whole market as a whole, I would say, is not rich. But there are some stocks that are. I wouldn't even call them rich. It's just they've moved so far so fast that to me, it's wait for them to cool off. Is my thoughts. The yield curve inversion, it's getting worse. Which watch my previous video that I put out a couple weeks ago about the yield curve. You need to know it. You need to understand it because it's a very good indicator of what's going to happen. And we're going back down again. So I've got the yield curve chart here. This sharp drop that we had at the end of March. At the end of March, we had the banking crisis. So we're moving back into that direction, and it's not doesn't mean that banks are going to blow up again magically when we hit that number. But it is not the best thing to see. We do need to see the yield curve start to uninvert, and then once we get uninverted, we'll be looking for a recession to slowly start coming our way after that. But we still need to uninvert. So in the meantime, we're just waiting. So bull case, the first four here are more of longer term bull case catalysts. The bottom two we could talk about. So flight to quality in stocks. Again, I think that's contributing to the narrow breadth is people are saying, well, if these banks are going to blow up, I'm just going to park some money into Apple because if Apple blows up, the world's going to end. So I think you're seeing people say, instead of holding these long duration assets, let's just hold, what's longer duration than Apple stock? That's a pretty long duration asset. You're going to hold that thing for a long time, or Microsoft or whatever. So I think that was contributing to the narrow breadth in the market. We are starting to see those things broaden out. But because of that flight to quality, it did create these crazy moves. If we were to rewind 6 months ago, and even now, there's people that are still negative and bearish. I'm halfway in that camp, and I've been pretty negative and pretty bearish on the market all year. But you can't fight the tape. The market looks good. The numbers are looking good. So there's a lot of good things in the economy. I just think it's going to take longer for the full effect to really kind of work its way through. And how will we do with that? Who knows? So the flight to quality in stocks, that is bullish for stocks, right? Because money's going into stocks instead of going out like it was last year. And then we also have the FOMO / catch-up trade. So the FOMO is fear of missing out. So there's been a lot of people that have been bearish and that have been negative on the market and said, let me just park my money in a money market account and not participate in the market because it's going to keep going lower like it did all year last year. Those people are sitting there looking at Nvidia go up what feels like 1,000%, and Facebook going up high, and Tesla going up high, and Microsoft and all the chips, and saying, That's great. I got 4%, but I could have got 14% in the S&P. I think that's what the S&P's up this year is 14%. So you're going to see people start to peel some money out of their bonds and start going into the market looking for some more return. And that is bullish for the market. That is a bullish catalyst because there's a lot of money on the sideline. There's a lot of people that manage money for their clients. And if they go to their client and their client's looking at the market says, I gave Johnny, my financial advisor, $1 million, and you're watching the news and you're seeing Nvidia skyrocket and Facebook skyrocket and Tesla skyrocket. You're thinking, Johnny better have bought some of those stocks, and then you call Johnny, and Johnny's like, I've got your money in bonds. You've got a 5% return. You're like, 5% return? Nvidia goes 5% an hour. So there's going to be forced buyers, like there always is forced buyers. Everyone's putting money into their 401ks and things like that. So FOMO / catch-up trade, and we'll talk a little bit more about that in a minute. Let's show the breadth here. If we go to 6 months, a lot of green and small amount of areas, very concentrated, narrow breadth. A lot of red in other places, like utilities, like healthcare, like staples, like energy. A lot of red here if we look on a 6-month chart. But if we start to shorten this up, 1 month, a little bit more green. And then if we go to 1 week, a lot more broader. So we hope that this continues for the sake of the market rally. This will help sustain the market rally. Energy and healthcare are still very red, so we'll see what's going on there in the near future. So let's go over a few opportunities to look out for. Healthcare. So I do think there's an opportunity in healthcare. The way that I plan on playing this is through the XLV. So the XLV is an ETF that has a big basket of healthcare companies and pays a decent dividend. So this is one that I am dollar cost averaging in one of my portfolios to slowly build a long-term position, because we're always going to need healthcare, and sure, it can fluctuate up and down, but I'm just dollar cost averaging. Buying on the red days. Today was a good day to pick up a few shares. I didn't do anything in here today, but I will look to if there's more weakness, and just in general to keep dollar cost averaging here. What I like about a chart like this is that it's basing out, right? It's not looking like a Tesla where it's just gone straight up here recently, or what's another one? Let's go to my favorite, Nvidia. This is a scary chart to buy because it's just moved so much so fast. I mean, we were $114 and now we're $430. The higher it goes, the higher the risk. So just keep that in mind. I'm not saying it can't go higher, but you want to buy low, sell high, not buy high, sell low. It's great to buy high and sell higher. So anyways, healthcare is something to keep an eye on because it's hated right now. It's red. Now energy is hated as well. I have a hard time with the energy trade. I'm not going to get into that today. I've talked about it in previous videos. Just not my jam. REITs, real estate investment trusts. Now this one you really need to be careful on what you're owning. I'm going to make a separate video that goes over some of the REITs. There's a ton out there, but be very careful here. Make sure you know what properties are in these REITs, because you don't want to get stuck with a REIT that owns a bunch of office buildings and malls in San Francisco. But I do think there's an opportunity here. And my main strategy here when I'm talking about these opportunities is right now is a time to be building positions for the long term. I'm not doing a lot of trading, but if I scale into a position and it makes a big move, then it's a trade. Let me show you a couple of examples. I know I've talked about Palantir. This was one that I was accumulating here as it's bottoming out. on the dips. I was buying all throughout here. Boom, parabolic move. I'm out. If you double your money in a week, I'm out. I love the company, but there wasn't a lot of fundamental change here. It just was AI, the AI hype. So I still love the company. I'm wanting to get back in. I will get back in, but I just want it to cool off. When things get a little casino-like here, it just doesn't end well typically, and it can go much higher before it eventually makes its way back down. But that's just the way I'm trading. Same thing here with SoFi. I was building a position. Like the company a lot. Still like the company a lot. But I mean, that's just, it's parabolic. And just like I said, these tend to not end well. And if I get a quick double, quick triple within a couple of weeks, I can't complain. So I'm going to take my chips off the table. What you could also do is you could sell half your position, a quarter of your position, whatever it is. But I really wanted to build a bigger position here. And if I'm buying it at 6 and then all of a sudden it's 9, I don't feel like buying so much at 9. So I'll wait for it to just settle out. Even if it bounces around here at 9 for a few months, then I'll start building a position again. But when it just skyrockets, what you have happen is you get resistance from above and resistance from below. So let's go through this exercise real quick. For people that bought SoFi at $5, and when SoFi reaches $8, those were people that bought well and are looking to take profits off the table, right? Kind of like what I did. But on the flip side of that, you may have a bunch of people that bought up here at 14 and have been holding it, watching it go to 4 and 3 and 7, and when they get a parabolic move, they may say, I'm out. I can get out with only a 10% loss. I'm out of here. So you have resistance from people that bought well, and you have resistance from people that bought poorly and finally have a chance to get out. So, yeah. And again, the RSI, the relative strength index here, is just super off the charts, which is not good to enter a position. Just means it's a little overcooked. So this video is going on forever. Let me finish it strong here. Bonds. Let's look at bonds real quick. So treasury bonds, they are pretty attractive here. So if you're an older individual, I think the 60-40 is back. I personally don't own any bonds. For me personally, that's where I'm looking at things like REITs. I'd rather get a yield in a REIT. If I can purchase the REIT at the right time, I can get appreciation in that stock, but also I get a quality dividend that is similar to a bond yield. So for me, I have a higher risk tolerance. I have more longer time horizon. I'm going to be much more aggressive on equities and less bonds. But if I was 55 years old and looking to retire in 10 years, I would be much more heavy in bonds, maybe 60 or 70% bonds. I'm not a financial advisor. This is not financial advice. Do your own damn research. I'm a dude with Dave Chappelle and a bird over my head, okay? So take everything I say with a grain of salt. Let's finish up strong here. I'm just yapping on forever. Buyable dips in tech. So Tesla is killing the game. But again, nothing's changed. It's just the news comes out and the market realizes, oh my God, Tesla's got the best technology. Oh my God, they got the best manufacturing. All the things we've talked about in the past. And then the market, this is also a perfect catch-up trade, right? AI is all the craze. And then people finally realize, oh yeah, Tesla's an AI stock. Let's go run that sucker up. So this is one where I am looking to buy the dips, but I'm going to be very patient here because I already own a lot of Tesla, and I'd like to own more. But for example, if you've bought some down here in the hundreds, it's kind of hard to buy some more up here. This is not the best way of thinking because I have a very strong opinion that this stock is $256, $800 billion market cap. I see this being an easy double in 3 to 5 years. No problem. $500 stock, no problem. So if I think it's going to be $500 in the next 5 years or so, what's the difference of buying it at 120 versus 220 or even 320? It's still got a lot more to go within the next 5 years. But on the other side of that coin, we could have some short-term catalysts that may be pushing it lower. And it's way overbought here too. RSI is as high as it was at its all-time high there. And then after the all-time high, it went from 400 down to 100. I'm not saying we're going to have some crazy drop like that, but yeah. You want to buy when the RSI is low. When this thing is hated and everyone hates Elon, you want to buy. When it's loved and everyone loves Elon, you want to be more cautious. So buyable dips, but wait for the dips. Just because it was down 0.5% today, I wouldn't be loading the boat. If you want a dollar cost average, a share every red day, that's fine. But buyable dips, but wait for there to be actual dips. Avoid FOMO. Just don't plow in right now in Nvidia, or I mean, do whatever you want. You can do whatever you want, but I would highly suggest to avoid the temptation of FOMO, and that's where I think it's much better to scale into these positions and even scale out of positions. So when I sold SoFi, I sold it in chunks throughout days, and that was actually a good thing because when I sold 25% of my position, the next day it went up another 8%. Then I sold another 25, and then it went up again, and then I sold another 25, and then it went up again, and I was out completely. So for your mentals, like Marshawn Lynch says, it's better to scale in and to scale out, just so you don't feel like you have to be in and out, in and out, in and out. That is very much that is hard to trade that, and yeah, your emotions are going to get the best of you. Small caps, I think small caps are going to contribute to the catch-up trade. If we get the catch-up trade, nobody knows. But if we do get a catch-up trade, you're going to see some of the small caps catch up to the big cats, like Microsoft and Amazon, because there's a big spread there, right? Microsoft and Amazon are way here. These small caps are way down here. One is going to have to meet up with the other. They're going to have to start closing that gap. Now, will the large caps come down, or will the small caps come up? So if there are some small cap stocks that you like and you like them long term, and they haven't made a parabolic run like SoFi, might not be a bad idea to start scaling into some of those and seeing if the catch-up trade happens. And if it doesn't, that's fine. Maybe you get a better opportunity to buy a company that you like for the long term at a better price. So I apologize for this hour-and-a-half video that I just created for you. I hope there is value in here. I'm going to make a video going over crypto, a little crypto update. I haven't done one of those in a while. If you want to see that, check it out. If not, enjoy the sunshine, everybody. Stay healthy, and I will talk to you all soon. Peace out.